Well, thank you, Brandon, and welcome everyone. Glad to see you here again today. Many faces look familiar, and some new faces that we're thrilled to have here at Day at the Races. As you know, if you've been here in the past, I like to start out with something a little bit on the lighter side, given the fact that we're going to be talking about some technical topics, and they might be, well, quite frankly, just a little bit boring. So on the lighter side, did you guys hear about, did you hear about the two antennas that got married? The wedding itself wasn't much, but the reception was excellent. With that, I'll stick to my day job. Short and sweet. Okay, so I'm going to talk to you a little bit about internal controls. Now, how's that for an exciting topic? We're going to talk specifically about some controls that you should have in place for your qualified retirement plan. Some of this might be new to you. You might not have any in place today. And I just want to give you some thoughts and ideas of what you might do to put some controls in place around the operation of your plan. So, internal controls, what are they? It's simply the who does what, when, how, etc. And how have you gone ahead and documented that? Why is that important? We'll get to that right now. The IRS has a view on controls that you should have in place, and we're going to see a quote from Monica Templeman. She recently made this statement. She said, if a plan is selected for audit by the IRS, oh gosh, let's hope that doesn't happen, but it might. The agent conducting the plan examination will begin by evaluating the effectiveness of the plan's internal controls. So that's where they're going to start if a regulator comes out to look at your qualified plan. And then they're going to use that to determine whether to perform a focused audit or just look at 3 or 5 issues. They might expand the scope of their audit depending on what they find. So in other words, she says, based on the strength of your internal controls, the agent will decide to examine more or less. I'm sure we would like less. The agents, I'm sure, are wonderful people, but we would like them to move on to their next piece of business and get out of our operations. So with that, let's first talk about plan transactions. The ins and outs of a qualified plan, the transactions over which you might want to have some controls in place. They're pretty simple and straightforward for most plans. There are going to be contributions coming in from both the employee and the employer. There are going to be money flowing back out of the plan in the form of distributions and loans. And then there are going to be plan expenses. So I'm generalizing quite a bit, but those are generally the top or main transactions that are going to go on in your plan. So what might you do as a plan sponsor to put some controls in place around those transactions so that when a regulator comes in or when your plan auditor, like myself, comes in and starts asking questions about the plan's transactions? So some things you could do. You could reconcile the payroll totals to the plan trust statements. So at the end of the pay period, add up all the employee contributions. Does that actually match up with what got into the plan? Have you reconciled that? You might want to do that quarterly, every pay period, at least on an annual basis, just to make sure that the money that you've withheld from employees and the money that you've contributed as a plan sponsor actually shows up on the plan statements. You might want to look at some things like irregular compensation. This is by far and away the biggest area where I know myself, when I'm auditing a plan, find errors. And when I say the biggest, if you took the whole total population of errors that we find on an audit, I would say half of them have to do with whether or not the plan sponsor used the correct definition of compensation in calculating contributions. So you might be running along through the year, everything's going smoothly, and all of a sudden you pay a bonus. Maybe it's been a couple of years since you've paid a bonus and nobody really is sure. Do we withhold 401k on that? Do we match on that? Yes or no? You might have overtime pay type items. Does your payroll department know how to treat those items when it comes time to making contributions? If you get it wrong, well, guess what? It's a qualified plan, so it has to be corrected. So it's not the end of the world, but you want to know. You want to make sure that who's ever operating payroll, that they're aware that, okay, we're paying a bonus, and how do you treat this? We make contributions on it or not. And where do you look for that? A plan document. Plan document or adoption agreement is going to tell you whether or not you contribute on those items. You should have some controls in place to monitor annual contribution limits. The 17,500, I believe it is now, and perhaps the 18,000 now. Do I hear 18.5, 19?
Only if you're over 50.
Only if you're over 50. So there are many limits that you should have in place, and don't just assume that your payroll provider has properly coded those into your payroll software and that they're getting them correct. So you might have someone check those, make sure that people aren't going over the limits. If they do, they have to get that money back. So it'd have to be refunded back out of the plan. And then lastly, I'm going to guess almost none of you do this, but it might be something you might want to try. Compare the salary deferral election forms with the amounts deducted from the employee's wages. Can you prove the contributions that went into an employee's account by going back to their personnel file and looking at their compensation and how much they elected to defer? That's one of the things that I'm going to look at when I come out to audit a plan. It's one of the things the regulator is going to look at. Are you able to do that? Are you ready for those sorts of questions? And can you prove that what they elected got withheld? Contributions. Employee and employer. The other thing you might want to keep record of is the timing of making your deposits. That's something that Chris might touch on or might not, but I know that if they come out to look, that's probably one of the areas they're going to look at. You withheld money from somebody's pay. How long did it take you to get it into the plan? Keep a record of it. The best time to do that is when you're making the deposit. You might put together a schedule, something like this, a very simple example in your handouts. What was the pay date? When did you make the deposit to the plan? What was the dollar amount? And you've got it all tied out. As a general rule of thumb, it should be within a couple days of the pay date. As soon as administratively feasible is what the regulations would tell you. I always, as a rule of thumb, tell people that you have to make your payroll tax deposit on a certain day, perhaps on the pay day or within a day or two thereafter. Your 401k deposit should be happening probably on that same day or within a day or two of that payroll tax deposit. General rule of thumb. Also, as you can see, some of those items in particular surrounding contributions have a lot to do with spreadsheets and reconciliations of dollar amounts, et cetera, and whatnot. I would just encourage you that operating a qualified plan should be a joint effort between accounting and HR. That I would call a best practice. I often go to clients where the benefit plan has been turned entirely over to HR or vice versa. HR has its strengths, accounting has its. When it comes time to reconcile, make sure people are enrolled, et cetera, I would say operating the plan should be a joint effort between the two functions within your company. With respect to distributions and loans, what controls might you have in place? What is the approval process? This has changed over time, certainly. We've just talked about it a little bit. Historically, people had to come in, fill out a form, and you would sign off on it manually. And that's the way a lot of plans are still done. Question is, who has the authority to sign off on that distribution? And what happens if they're out? Who's their backup? That should be documented somewhere. Or perhaps, nowadays, a lot of this happens electronically. A lot of you are sending payroll feeds to your TPA on a regular basis, maybe every time you run payroll. And some systems are set up such that if there's a termination date in one of the fields that you submit to your TPA, you just authorize the distribution, whether you may know it or not. It's probably in your service agreement that tells you what they're going to do with the data that you're giving them. So the question becomes, Is the person entering that term date in that field authorized to do so? Do they understand the implications of dropping that date in there? Because the TPA is going to get that. Participant's going to call in and ask for a distribution. If they see that term date, that's the approval, and they're going to go ahead and pay them out. So if that's the way your plan is set up, are you aware of that? Is the person that's entering that information aware of that? And are there controls around that? Is that documented? Loan eligibility. Unfortunately, people sometimes need to take a loan out of their retirement account. I personally wouldn't encourage it, but it happens. Who's able to authorize those loans? Are there certain restrictions around loans? Do they know what they are? And is that process documented, and who does that? RMDs, that's an abbreviation for required minimum distributions. Participants that are age 70 and a half are required to start taking money back out of the plan, and there's an IRS formula to calculate how much that is. Who's responsible for that? You, the record keeper? Do you know? Is there someone at your place of business, or does your service agreement address it? If you miss these, it's a kind of a big ouch. For the participant that misses these, there's a 50% excise tax on the amount that should have been distributed. So you don't want to be the one that misses it and having the employee coming back to you and saying, hey, wait a minute, we owe this excise tax now. I think you're responsible for it. So let's make sure we know who authorizes RMDs and who's monitoring them. Who's watching the employee population for those people that are over age 70 and a half, making sure that they get their money back out of the plan. Yes?
When you say the employer is responsible, can they be liable for that?
Well, that I don't know. I'm not a lawyer, but I wouldn't want to be in that position with an employee coming back to you and saying, you know, hey, you didn't let me know about this. I'm just an employee here. You're operating this plan. Why didn't you process this distribution? I think you'd be in a bad spot with that. Legally, I don't know the answer to that. That's a very good question. A couple other things with distributions that are important are the number of years of service someone worked, because that's going to play into their vesting, how much that they're owed, and perhaps the marital status if there's spousal consent required. A lot of plans no longer require spousal consent, but there are some plans out there yet that have provisions that not only the plan participant has to request the distribution, but their spouse has to agree to it. So make sure you understand what that is and you're obtaining those prior to paying somebody out. Plan expenses. I'm not going to talk about whether or not they're reasonable. That's a whole other topic. Probably take 3 to 5 days to cover. I'm just going to talk about the fact that you've got some expenses and now they need to be paid. There are some things you can pay from plan assets. Who at your place of operation is allowed to approve plan expenses, and what are you going to keep for supporting documentation? Invoices, otherwise, receipts, whatnot. What are you going to keep to support the amount that you're paying? Generally, allowable plan expenses are the expenses that you incur in the day-to-day operation of the plan, including, for like myself, an audit fee. For us to come out and perform an audit of your plan, that's something you can pay out of plan assets. Anything that really has to do with the day-to-day ongoing administration and operation of the plan is generally allowable to be paid from plan assets. Now I say allowable, the next question is, does your plan document say that you can pay it from plan assets? And then you get into the whole question of as to whether or not it's reasonable. There are some things that you cannot pay out of plan assets, and those are called settlor expenses. And generally those are the expenses of setting up, designing, terminating a plan. Those are all settlor functions and cannot be paid from the plan. So if you think about it, when we're talking about paying something out of the plan, what you're doing is essentially in a defined contribution plan, you're taking a little bit of money out of everybody's account. So there's only certain things that you can do with employee money. Use of the forfeiture account. You'll have a forfeiture account which is the accumulation of all the account balances that weren't fully vested for people that you paid out during the year. And that'll build up in the plan. The IRS would tell you that you need to zero that out on an annual basis, regardless of size. Maybe $1,500 sitting in there. You should zero that account out in some way, shape, or form, at least annually. You'll want to look to your plan document that will tell you how and what you do with that. Oftentimes it's used to reduce a company contribution, so you can offset your next deposit and have the balance moved out of the forfeiture account. Sometimes it's used to pay plan expenses. But probably the key thing there is to make sure that you're clearing that account out at least once a year. Okay, one of the things that's not on your slides that I'm going to touch on is something called a SOC 1 report. Just so you know, a SOC 1 report is an audit of your service providers. So say your plan is with Principal or Fidelity or Vanguard. Those places have hired an auditing firm to come in and audit their processes. We touched on this earlier. A lot of transactions today are done over the internet or a toll-free phone number, and there isn't a whole lot of paper out there. So one of the things an auditor is going to want to obtain is an audit of the record keeper's processes. So the auditor goes in to the record keeper and audits the transactions that get processed at their place of business. Your participants calling in, changing their fund elections, their deferral elections. Are those systems working properly? And then they're going to write a report with the results. And these reports, I don't know if you've seen them, they go from 60 to 100 pages long. They go very in depth. They will tell you exactly what they tested and exactly what they found. Included in there will be a section called user controls. And the users would be the people in this room. The users are, think of the concept of garbage in, garbage out. Your TPA is going to process what you gave them. So they're going to say, TPA, you need to send me correct data. And you should be doing X, Y, and Z to make sure that the data you send me is correct, and then we're going to process it. So they're going to say, you should have these controls in place at your place of business in order for our operations to work properly. So many plan sponsors that I work with, when I tell them about this, I kind of get the deer in the headlight sort of look. I didn't realize that. I didn't know it was in there. Didn't know they expected me to do that. Now you do. I would say check with your provider. Ask them for their most recent SOC 1 report. And there'll be an index in most of them because they're so voluminous. And you can go to that user control section and understand by user they're referring to you. And they're saying these are the things that you should have in place at your place of business in order for the record keeper systems to be reliable with what they're doing with your data. So let's now turn to, that was mostly around transactions and whatnot. Let's talk in general about plan operation and management. We find that many sponsors of plans are unaware of the duties of prudence, loyalty, and diversification of investments that they have as a fiduciary, or even the fact that they are a fiduciary. If you have any discretionary control or decision-making over plan assets, you are a fiduciary. Probably almost everyone in this room. Do you make any decisions regarding the plan? Do you advise people on when they're eligible? Do you talk to them about how much they can contribute, etc.? Those are fiduciary functions, and you're most likely a fiduciary. And even in the event where there is no formal committee, nobody actually named as a fiduciary, someone is. Someone at your place of business, at a minimum, one person is a fiduciary, and it's likely several of you. So it's defined by responsibility, not necessarily what you have put in writing. And then, to make matters worse, what standard are you held to? You're held to the standard of a prudent expert. Wow, are we all experts in plan investments and tax issues and whatnot? Probably not. So this gets into where you can hire someone that is an expert. You can hire a Sam Vallejo to come out and advise you on the plan investments and whatnot. And that's wonderful, but you still need to monitor what Sam is doing, make sure you understand what he's doing for the plan. You can hire a Fidelity to do record keeping for you, but are you still monitoring what they're doing, and are you comfortable with what they are doing? So as we say on the slide, expertise can be hired out, but the fiduciary still has a responsibility for what that expert is doing. So I would suggest that you go ahead and take the steps to establish a plan committee. I would suggest that at a minimum you have someone from finance, CFO or controller, someone from HR, and someone from your legal department be on that committee. That would be sort of a bare bones committee, 3 people. You might want to add to that 3 to 5 maybe. Get beyond 5, we might start to have too many cooks in the kitchen and no decisions get made. But 3 to 5 people that you've named, identified, that are responsible for the plan, that meet at least annually. I would say 2, 3, 4 times a year would be best. But they should meet on a regular, scheduled basis. Keep minutes of their meetings. What did they decide, when, and that goes a long way. Certainly with an auditor like myself, and also with the regulators, I believe. I don't want to speak for Chris, but when they see that you've got a group of people in place that monitors the plan, they meet, they talk about it, and they're watching over it, you're going to get some things wrong, granted, but at least you're putting in the effort and you're demonstrating that you're monitoring what's going on with the plan. What are the committee responsibilities? There are 4 things that I put here. I'm sure that there are more. I'm going to touch on these a little bit. Your responsibilities are to follow the terms of the plan document. Select an investment menu and periodically monitor it. Hire and monitor service providers and monitor plan fees. Along those lines, terms as laid out in the plan documents, this seems to be obvious, but maybe I'm preaching to the choir with you folks that come to these meetings, but you'd be surprised. I go to clients and payroll is completely unaware of where the document is, or what the definition surrounding compensation is, or how that has anything to do with their day-to-day functions. When I come and audit, when I do an audit, the audit that you'll attach to your Form 5500 filing, that's the primary thing that I'm looking at. Are you operating the plan day-to-day consistent with what the plan document says the plan should be operated? And if not, it needs to be corrected. So are you doing that? Is payroll up to date on the plan? When you make an amendment, who needs to know about that? Does payroll need to know about it? Does HR need to know about it? Who are the people that need to know that are going to be affected by that amendment? And then how are forfeitures handled? We talked about that earlier. Are people aware of that forfeiture account and how it should be used? Selecting the investment menu and periodically monitoring that. I would say you should meet on a regular basis with an advisor, someone like Sam at Morgan Stanley. Make sure that you understand what the plan is investing in, why you've chosen those investments, and are they prudent investments going forward. I see lots of plans that were smaller, that have grown, that have 30 different investment options. If you look into them deeply, there's 5 small cap funds and no large cap fund. Why is that? That is not an appropriate menu. So is someone monitoring that, making sure that the investments are appropriate, that there's an appropriate number to choose from? I'm not an investment advisor, but if you have 30 options in your plan, I'm probably thinking there's too many. You're probably confusing your plan participants. 10 to 12 might be a better number. Maintain minutes of those meetings to document, again, what you've done, that you've been responsible for the plan, and you can demonstrate that. I mentioned you have this standard of being a prudent expert, and we're not all experts, so you can hire people that are, and then monitor them. There are a lot of services out there now that will benchmark your plan, so you can see what your contributions are for a company of your size versus what other companies in your market space might be doing. That's always a good idea. You need to hire an auditor to audit the plan. That's something that I do. I see a lot of We're going to touch on this in a bit. I see a lot of audits that just are not very good, and that's going to be consistent with some statistics I show you in a moment that will probably shock you a little bit. I think they're, well, I'll let you decide. We'll look at it in a moment. Monitor plan fees. And when we talk about monitoring fees, I want you to keep something in mind. It's not the lowest fee that you're looking for, right? I mean, we can shop at Kmart or we can shop at Macy's, and you're going to get different product. So when you're looking at plan fees, it's not a question of, did I select the lowest fee possible? You're probably going to get exactly what you paid for, just like with any other product. So it's a matter of, is the fee you're paying consistent with the service you're getting? And it might be the middle of that, and it might actually be the high range of that. You might have a plan where you want to do things with extra bells and whistles, and you're going to need to pay more for that, and that's okay. So not always just looking at the lowest fees. Keep that in mind. So some statistics that I wanted to share with you that I think are just, well, let me just read to you what is underlined here. This was recently, as in just a couple of days ago, from Susan Coffey at the AICPA. She said more than 1/3 of the audits that that was the regulators, the DOL, more than 1/3 of the audits looked at had quality issues. Now, you folks are all in business. If you had a 1/3 failure rate on your product, what would that do to your business? It would not be good. So when I talk about hiring somebody that's qualified, hiring somebody that's charging the right number, hiring somebody that's getting paid for the level of service that they're doing, when it comes to plan audits, specifically, this is saying that regulators have gone out, they've looked at the work that accounting firms have done, and they believe that 1/3 of the files they've looked at are deficient in some way. I think that's pretty shocking. And why is that important to you? Well, check this out. So the regulators, the Department of Labor, that look at auditing firms and the work that they've done that and they've issued reports. However, their regulatory authority is not over the accounting profession, it's over plan sponsors. So if they're finding a deficient audit, depending on the degree or whatnot, they're coming back to you and saying, you attached an audit to your 5500 that was deficient, and now you're going to get to fix it. And that can be time-consuming, expensive, etc. So I think there are some things that you need to maybe look at a little bit closer when selecting an auditor. I will go ahead and say that, yes, I am biased. Okay, so we'll just get that out there. But some things that you might want to consider when you're hiring an auditor for your plan. Hire someone that's a specialist, that has some specialized expertise. These plan audits they're just unique. Let's just put it that way. There's this whole concept of materiality that auditors use that works great when you're doing a company financial statement, etc. But when you're working with an employee's retirement account that's missing $75, it's missing $75. If that was your $75, you'd want to make sure it was there. So there's a whole different view, a whole different mindset for an auditor of a qualified plan than someone that's maybe doing a financial statement audit for a company. And you probably need some specialized expertise to be able to identify that and deal with it. And we oftentimes enlist the help of an ERISA attorney. I would also say you want your plan auditor to find the problems that are there. You have options when I find it. You don't have as many options when a regulator finds it. They're going to advise you on how to fix it. I'm going to tell you what your options are and how to fix it. We're going to involve ERISA counsel, and we're going to do some things. You'll have more leeway with any sort of corrective activity. So on through the list, I would suggest you look at someone that belongs to the AICPA's Quality Center for Employee Benefit Plans. It's a response that the AICPA has had to the quality issues surrounding plans. Auditors that belong to the center are required to have additional CPE, continuing education in plans. They're required to have more of their audit files available for peer review, etc. So there are some guardrails in place for that. So I would look for somebody that belongs to that center. Someone that knows qualified plans, perhaps has certain industry designations ASPA, for example, has I'll just call it an accreditation sort of program where you can go through a certain series of programs and get certified, I'll just call it, through ASPA, and it's specifically geared toward knowing and understanding ERISA. And then also an ability to deliver in a timely manner. I cannot tell you, when I look at plans issued by firms, it seems they're all dated somewhere between October 1st and October 15th. And if you've been in that spot, you know it's probably not a very fun place to be. There's a lot of other things going on, and I ultimately believe it impacts negatively audit quality. So I would build and design and press for a June field work and a July delivery of a product. What that allows for is, I mentioned earlier these plans are tax qualified. If problems are found, they must be corrected in order for that plan to retain its tax qualified status. So if a problem is found in July, you have time to fix it. If that same problem is found in September, and now you're up against the rush of October 15th, it may or may not get fixed. And if you miss that filing deadline without an audit attached to your Form 5500, there are substantial potential penalties, up to $1,100 a day for the plan that's filed without an audit attached. Rarely does that level of penalty get assessed, but that is what you're up against. So with that, I'm going to turn it back to Brandon, and hope you enjoy the rest of your day.